really what determines the higher returns are the grade of the ore body. In this case, when you get to this analysis, you've already found the ore body and you got the grade, and there's no additional risk. You're mining 1 ton of either high grade or low grade. Mining's unusual in that respect.
Thank you, Terry from Power Nickel, for taking Arnes and my question. Now, my following question is regarding a couple of terms that are often coined in a pre-feasibility study, in a feasibility study, namely the NPV, the internal rate of return, the CapEx and Opex. Perhaps you can explain them in a bit more detail.
Yeah. So as an investor, when you see those terms, you basically, your objective is to look at what is a CapEx. CapExes can be quite different on various nickel projects. Like if you're in a low-grade sulfide or laterite project, it might be CapEx.
Sorry to interject real quickly, but could you perhaps explain what CapEx is?
Capital expenditures. So, it's basically what it would cost to build the mine. And so when you look at your capital expenditure, it's like, okay, this is how much money I need to actually get into the mining business. And then the question is, well, how likely am I to get this mining CapEx? And that's largely determined by the returns that CapEx drives. So there's two ways to measure the returns, really. One is the internal rate of return, the other is the net present value. So at the end of the day, the IRR is basically measuring on a return of capital. On these laterites and sulfide projects, they're around 20%. For projects like, I would think Power Nickel probably would be, in excess of 50%. So obviously higher returns are better than lower returns. And then on the NPV side of things, the NPV is, captures in the time value of the money. So that's another thing. If you have less capital expenditures and you get returns earlier, you tend to have higher NPVs and be much more likely to get in business. So those are things for investors to watch for, and it's part of their investment analysis.
Thank you for your excellent explanation. A quick follow-up question regarding those higher returns you were referring to. Normally in business school, in finance classes around the world, people are told that higher returns correlates with higher risk. Is that also the case with mining companies, or not necessarily so?
Yeah, not necessarily so. That really what determines the higher returns are the grade of the ore body. So in this case, when you get to this analysis, you've already found the ore body and you've got the grade, and there's no additional risk. You're mining 1 ton of either high grade or low grade. The low grade drives lower returns, the high grade drives higher returns. There's no actually fundamental difference in the risk. So mining's unusual in that respect.